I love doing covered calls on CRISPR Therapeutics because the premiums are always juicy. Even when the stock was down here, the premiums were juicy for where the stock price was. So I took some off yesterday, and I think I closed this at like 85 to 90% of max profit, somewhere in there. And that was per contract. But you can see here, my cost basis on my shares is all the way up here at 76. So this entire time, because this is a long-term hold. Remember, this is not a trade. It's a long-term hold, right? So I've been averaging down, averaging up. I've just been buying shares incrementally for the past 3 years, okay? I was buying shares here and here and here and here and here and here. You guys get the point, right? But the entire time I've been down on this position, I've been writing covered calls, but I have to do it a certain way. Okay. So if my cost basis is all the way up here, and my cost basis has fluctuated greatly over the past 3 years, but let's just say for this example that my cost basis remained the same at 76 bucks. Okay. Well, clearly this stock has not been over $76 since, well, August of 2022, okay? And actually, even then, it wasn't even above it very long. So we see that, because I remember this, we had a pop, and it stayed up around this level for about a week or two, and then it went right back down. So really, this entire time, it's been below my cost basis. So how have I been handling that? Okay, well, ideally, I'd like to sell a covered call at my strike price all the way up here at $76 or higher. So that way, if the stock runs up, okay, I get my shares called away for a profit. But here's the problem. Back when the stock was here or here or here, okay, stock was at like $40 here. Stock was at maybe $50 here. The stock was at $45 here. And if I sell a covered call all the way out here, if I had to take a guess, this would probably be like a delta of like 2. And we all know that if we go to an options chain and we look at a 2 delta, you're not getting any premium. So you're putting your shares, quote unquote, at risk, even though it's highly unlikely that you would lose your shares, for hardly anything at all in premium. Okay. So ideally, yeah, I would like to sell them up here above my cost basis, but I didn't really have that option. So what I was doing for, gosh, it seems like 2 years now, is I would do my normal covered call. Okay. So if the stock was down here at 50 bucks, okay, I would sell a delta 20 or whatever, but it was more so predicated on what the stock was doing. Okay, so if I go back here, all right, so if I saw the stock run down, and I see it really extended here and here, okay, would I sell a covered call there? No. It makes no sense to do that. It's way too extended to the downside. Instead, what I would do is I would wait for stuff like this. I would wait for strong sell signals, which is right in here or in here, so I can get it to fall. So that way, I didn't have to do a delta 20. I could actually go a little bit closer to in the money. I might do a delta 35. The closer to at the money you go, the more you're getting a premium. Also, though, the more likely you are to get your shares called away. So you can imagine that I had to take extra precaution whenever I did that. Okay, so let's say the price is right here. Okay, and I sold a cover call right here. And let's just say this is a delta 35. Okay, we got a spike right here. Okay, well, I could just say, well, I just want to keep the premium. I could let my shares get called away. Well, if I get my shares called away, that's at $57 per share, roughly. That's a huge loss on my shares. My shares are all the way up here at 76. Okay, that's a big, big loss. So is the juice worth the squeeze? Yeah, I think it is if you handle it correctly. So that means I have my finger on the trigger. If the stock pops up here and it really starts to get away from me, I have to have my finger on the trigger to either close it for a loss or be prepared to roll it.